Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. When does a three candles project long term gains? Geopolitical events explode onto the front page of news, and so does crude oil. But was this rally already in the cards despite the catalyst? And what do rare earths, small caps, and happy meals have to do with the largest Treasury buyback in history? All that plus your questions, and to help me with today's show is my co-host, Mr. X. Hello, Thomas.
Hello, John. How are you?
I am surviving this week.
Been a busy week, and then kind of crazy finish. Right, heading into the weekend. I wasn't really expecting it. Expecting that kind of bad news right now.
Yeah, well, we did our planning last night, and a lot of things we wanted to talk about, and it was like we kind of had to throw them out the window with what was going on, with the geopolitics. But I think we have a good show today, and I think folks are going to enjoy it. So
Yeah, we got a great variety of topics. Hopefully, we got something for everybody. Before we jump into that, just a quick reminder for those of you watching directly on our website, if you want to ask a question, just click ask a question at the top right. You'll see it highlighted in the orange color. If you're watching on YouTube, go ahead and ask those questions directly in the chat, and John and I will get to as many as possible. All right, John, last week you asked our special guest, Tom Lee, how he was able to predict the V-shaped recovery in the stock market. And he said that when prices fall as fast as they did, it's known as a waterfall stock market decline. And he mentioned that there have been 12 prior instances of that happening. And as long as the economy didn't fall into a recession, it resulted in a V-shaped recovery. So that's why he had the confidence to make that call that he did. But John, I think you might know the waterfall decline by a slightly different name. What do you think?
yeah, I've been actually studying this chart pattern for a long period of time. Not only do I study it, but I trust it and trade it a lot too. Yeah, I call it a cascading capitulation, or in candlestick theory, I call it a three candle drop, where you get a little candle, a baby candle, a mama candle, and then you get the daddy candle. And then I've, in the past on our show here, I've taught you how to trade that sell off. And the first rule is you got to wait for the first green candle. But what I haven't shared with you, and what something that was interesting, what Tom said, was that he called this symmetry of the V bottom. But what I bet he didn't understand is that there is actually a symmetry to post V bottoms. In other words, if the market can recapture the origin of the sell-off, then what you can do is you can extrapolate the depth of the trough, and that will give you a projected top or target at some time in the future. Now, I want to be very clear here, is that this is not a one-way street, okay? This doesn't happen right away. Think of this more like like the starting gun of a road race, right? The road race is going to have twisted turns, ups and downs. What this is showing us is a potential target or finish line to what is something I call the cycle of price, not a price cycle, but the cycle of price. So yes, we can extrapolate that into the future. So let's look at what's going on currently. And so here's kind of that V bottom, which Tom was talking about, where we get this cascading sell-off and then, this nice little quick recovery. Now, again, when we talk about markets, you've probably heard the expression that bears take the elevator and bulls take the stairs. And you can see that here's the elevator down and then here's that slow climb out. But if we can get the market back above the origin of the sell-off, then we can extrapolate that price into the future. And so let's look at that. And so here we go. And that extrapolates to 66.87 sometime in the future. Now, again, bulls go up a lot slower. Matter of fact, strong bull markets never convince you to buy them. They just kind of creep up. Now, some of you are watching, you say, well, maybe that, why'd you pick this level, or how did you draw this? First of all, I used our 50% line, and I just basically did the trough to this high here. I like this high because it's where, we broke down, and then we gapped up. Now the origin really started on Liberation Day, which would be this red candle, this red arrow. And if we projected that trough, that would put us at 62.65. And some of you might say, well, the origin of this whole sell-off was up here by this orange arrow. And if we did that extrapolation, that would give us 69.20. But I really feel more comfortable and confident in this prediction. But again, this is not going to happen, in the same velocity that we saw with the sell-off. Matter of fact, here is a great example. This is the V bottom of 2018-19. And you can see that, it happened in a 1 month period, but it took 5 months to reach that target. Again, notice here's the breakdown. There's the breakdown. That's that accelerated cascading waterfall. And then here's our 3 candles there, 1, 2, 3. And then once we base or get above the origin of the sell-off, then you extrapolate that distance. And boy, in this one, I was doing this work. I hadn't remembered it, but I was like, oh, wow, this one really worked very well. So, just to kind of reiterate what we're talking about, this is a price pattern that I see. I see this in all time frames. I see this in all markets, and it's a really great trading tool. Again, the first rule is, how can you buy when you know this is over? You got to wait for the green candle to close, and we've talked about that in the past. But for longer term traders or investment traders, when you see these kind of V bottoms, and then the market can recapture those highs or the origin of that sell-off, then you can project that to a target sometime in the future.
Very interesting. Well, John, I love your projection, because at the beginning of the year, right, I said my prediction was S&P 500 would finish the year at 6717. John, it's basically right. It's basically right on that projection.
All right, pump your brakes, Notre Dame there. We'll see. We'll see if we get there. But yeah,
right, fingers
I don't know by the end of the year, but I think in terms of a price cycle, that is certainly a target that we can start to look for. Yes.
Fingers crossed.
Yep.
All right. So, John, we obviously have some geopolitical tensions right now in the world, particularly in the Middle East. We had a military strike last night, which sent crude oil soaring. And it's interesting, John, because earlier in the day, I saw a research note from JP Morgan, and they pointed out or forecasting that in a worst case scenario, crude could go to 130. Now, they're not necessarily calling for that. They're just saying in a worst case scenario, you could see that happen. Potentially war would seem to maybe fit the definition, John, of a worst case scenario. So question for you is, do you think there's a chance that we could see crude get as high as 130?
There's always a chance, right? And we don't know how far this could escalate, right? And I would say you'd have to have a real major escalation. In other words, world powers getting involved, not just these regional powers. But let's go to our crude chart, which is kind of interesting is that we had planned for this show today. We were going to talk about crude oil, and we were going to talk about crude oil for a lot of other reasons. One was that there was a lot of positive things that was going on technically. First of all, I had this nice little double bottom, and you could kind of see this little cup and handle here, this rising wedge, right? And then we had kind of that breakout, but the news last night really accelerated the market. So let's address what happened last night in terms of this $130. But I also want to show you that there might have been a catalyst that was actually driving crude oil prices higher. And we'll look at that in a moment. So if something happens with Iran, right, they only export about 1.7 million barrels a day, and all that goes to China. So there's your world power, right? So if something happens to Iran, China, right, this is who they buy their oil from. about 20% of, and again, if something happened to Iran, I think OPEC would make up for that 1.7 million barrels. About 20% of oil comes through the Strait of Hormuz. There's where you have that wild card. But again, I think the market is well equipped for these price shocks. So any kind of short-term disturbance, supply out of the Strait of Hormuz, then I think non-OPEC countries, U.S., Canada, Guyana, which is in South America, will make up for that difference. It would be an extended period. That's when we could talk about some much higher prices. I think 130, I think, is a little higher. I think 100 is probably definitely into the cards. But when we have one of these price shock events, what does happen to crude oil is we build in what is called a war premium, and that war premium is usually around $10. So you can see right about where we broke out of this wedge here, around $64, $65. We did spike up to that $10 war premium. Now, what I think what the market has now done is we've kind of settled in kind of this range, this pink bar range. And this is something what I would call is like a level where the market feels comfortable with. In other words, I wouldn't be surprised in the short run, next 6 months, that we are range bounds in this range between $67 and $75, maybe a little bit higher, $76, until whatever happens out there either is alleviated or is escalated. But before that, what I wanted to show to you guys is that we've talked about in commodities something called looking at pricing of commodities in terms of fundamentals. And there's something that's called backwardation and contango. And these are terms that are based on how the price structure of the forward futures contracts are. So if the first month is the most expensive and all the other contracts behind it are cheaper, that is called backwardation. That fundamentally, that is telling you that there is basically a balanced market, but is slightly in favor of tighter supply or stronger demand. And when the front month is cheaper than the further out contracts, that is called contango, and that is a fundamental that says that there is more supply or less demand. And so we can see here right now the market is in backwardation, which would make sense, right? Because there's kind of this fear. But here's a chart, and this is interesting. This is the December 25 contract versus the December 26 contract. And this is a spread chart. And we noticed this back in January that the backwardation was starting to decline. In other words, it was telling us that the front month was narrowing to the back months, which was telling us that supply was overtaking the market. And we saw that through most of this first half of this year. Matter of fact, it went from about $3 over to $2 under, a very well-supplied market. But you can see even prior to this spike that we just got in the last couple of days, we had gotten from the negative, now we got back to the positive. And this is a sign that the fundamental pricing, right? December crude oil probably has nothing to do with even a rumor of what was going to happen in the Middle East. But this is telling us that the fundamental pricing, the headwind of supply, is now shifting towards the tailwind of demand. And so this is something I'm going to be watching over the next couple of months to see if we maintain this. And this could be very positive for the energy market going forward into 26 and 27.
Okay, John. So, let's go to treasuries, John, which just, it seems to be a topic that just won't go away. I even mentioned it to you in our planning session. I'm like, John, I've really had my fill of treasuries. But
yeah.
Lots are going on with treasuries, John. Yields have been soaring, although they're down this week. There's more than $9 trillion worth that needs to be refinanced this year, which could be a potential problem, John. But what caught my attention was this.
Yeah.
And this is back-to-back weeks now. And again, guys, I'm posting this information on our X account if you're not following us. But the Treasury, John, they just bought back another $10 billion of its own debt. Now, this happened last week. That was the largest Treasury buyback in history. So basically what's happened is the Treasury has done back-to-back weeks of its largest buybacks in history. John, for our viewers who might not really understand what this means, what do you think is going on here?
Yeah, who needs the Fed to cut rates when you got the Treasury buying back their bonds? What this really kind of does is tells us is that the treasuries is kind of circumventing the Fed. In other words, creating maybe like this quasi quantitative easing. What they're doing here is they're trying to stabilize the long end of the yield curve. And now, why would they do that? Well, that would give, let's say, for business owners who, large cap business owners, when they do planning, right, they look at 5 years out, right? So if they're uncertain about where interest rates are going to be 5 years from now, again, the long bond rate, then that might slow down economic activity. But if the Treasury is going to buy bonds, in other words, buy bonds, keep long rates lower, similar to what the Bank of Japan did for 25 years. Now, I don't think they're going to try to push bond rates down to zero, but if they give that stabilizing effect, I think that is a tailwind for economic activity, which is also a tailwind for all assets, and particularly hard assets. So
Yeah, I mean, John, one of the things with the hard assets is, and I've been tweeting about this a lot. I'm kind of floored by how fast and how furious some of these assets have been going. One in particular is not something I've talked a lot about until recently, John, and that is platinum.
right.
Now, platinum has just been going nuts. I mean, you can see it, guys, here. I mean, highest price, John, in more than 4 years, and it hasn't been a gradual climb. It's just all of a sudden.
Yeah, I think this is kind of what's going on. We have our bond vigilantes are kind of fighting with the Treasury, but also this backdoor quantitative easing, right? Money is being pumped, liquidity is being kind of pumped into the market, and that is what I really think is you're seeing in these hard assets, these commodities. If we go to, let's say, let's switch to our futures page, Tom. This is our futures metal price page, and I've sorted this by 3 months performance. And there's your platinum right at the top. It's up 18% in 3 months. But it's not just platinum. It's gold, right? We know gold. We've been talking about gold for months. Uranium, palladium, silver, even metals, right? Look at that steel down there. If you look at from a year to date, only really aluminum, lithium, and uranium have negative results year to date. So this is a tailwind that is in the commodity space. And so I think there's a lot of potential in this. And again, this Treasury put, this stabilizing effect I think is going to help push these commodities. And so one of the ones that I was really kind of interested in, and this is again something that we've talked about, is rare earths. Rare earths have got a tailwind. Now, there's a little bit of that tailwind has to do with, what's going on with China and all that. But if I go, let's say, for an ETF, and I'm here, this is our ETF search here, commodities, metals, you can look at ETFs for basically any type of commodity, but in this case, the metals. But what I noticed was, so here is a USA rare earth. This is a stock. This is a rare earth stock. But what any of our pages on any individual stock, you can see what industry groups they are in. And so we're in the mining sector, miscellaneous mining sector. And again, I'm going to sort these. These are sorted by weighted alpha. Now, it would be no surprise if we opened up and see what these mining companies do, that most of them are in the silver and gold, right? But a lot of them also have other metals. But notice right here at the top of the list, MP, this is a rare earth company. This is a U.S. rare earth company. And so their stock has done very well as in this time frame as well. So again, and I'm just going to talk about a couple of these real quickly. TMC, they're a rare earth company that wants to try to find metals on the ocean floor. Wheaton, again, they have a mixed bag. Again, gold, silver, maybe some other ones. Look at down here, chemical. That is a uranium stock, right? We just talked about uranium. But let's look at this chart of MP, which I find really kind of interesting. I think maybe you folks will see the same thing. So yeah, nice move here in the same time frame, that 3-month time frame that we just looked at for all of the commodities. As a matter of fact, in this stock, from the beginning of this year, this is almost a double. Now, two things I want to point out to you. First of all, is I just talked about 3 candle drops, and some of you might say, "Oh, that might be hogwash or hooey or whatever." But there you go. There is the 3 candle drop. There it is, cascading sell off. There's that nice V bottom, climb out, measure the depth, and project the target. But in the case of MP, what I was going to show you here is, if you did Fibonacci analysis on this one, is, it had fallen very far. And what we're just getting back to is, this 38% line. And what we're in now I think is an area of resistance. So I don't think this is a FOMO trade. I think you have some patience. But there is room for here. It looks like it could run up to about $35, maybe $36. Again, into a zone where the market had been very comfortable for a long period of time. And that would still be a 20% gain from where it is today. I just don't think you have to rush to get it. But again, if the Fed this Treasury continues to play backstop with long end bonds, and then we get some clarity with China, I think this is a stock that should continue to appreciate.
All right, John. So let's switch gears and talk about kind of a painful subject for me, John, because I've talked about it multiple times, and there have been many instances where things looked really good and I was let down. And I'm talking about small cap stocks.
Yeah.
In particular, the ticker IWM. And I actually, John, I have to be honest, last week I capitulated a tiny bit of my position because I was looking at my portfolio, and small caps, they just weren't doing anything, John. They were an anchor in my portfolio. So for those of you who own small caps, it's probably good news for you that I capitulated. But John, the reason we're bringing it up again, IWM has had multiple closes above the 100-day. It just barely got above the 200-day, kind of peeked its head just above on an intraday wick. John, what do you see in the small caps chart, and is it finally time where the small cap bulls can sort of rejoice?
I don't think it's time yet, but I think we can look at some data that maybe will give you some ideas for when you could go into it. But always one of the things, and we're going to bring this full cycle, is you can come to any of our pages here, but here we are in the Russell 2000. And we have had some strong momentum in terms of moving averages, but a third of the Russell 2000 is only above the 200-day. That means 2/3 is below. And we know what we say about being below the 200-day, right, Thomas?
But nothing good happens, right?
Yeah, nothing good happens, right? So there is a correlation, again, to what happens in small caps versus what happens in large caps. And there was a recent article that came out through the CME, and they talked about this relationship of small caps to large caps. And basically what they said was that, let me see if I can make this nice and big for you guys, is that, during recessions and early stages of economic recovery, that the small caps tend to outperform, and that the large caps do better in the later stages of economic expansion. And so the light blue is where Russell outperforms, and the dark blue is where large caps outperform. So outperformance large caps actually means the line going lower. And you can see that for a very long period of time during this later stage of what has been defined as a post-pandemic rally, large caps have outperformed. So there is precedence into say, hey, yeah, statistically, we're probably due for some type of correction. But that correction, Thomas, I don't think it's going to happen until we get, some kind of economic easing, right? Or quantitative easing. Now, I think we've both agreed on that, right?
Yeah, absolutely, John.
So how does the Fed cut? Well, they're either going to cut if we have a recession, or they see the light at the end of the tunnel for inflation. So I don't think the inflation story is going away. We just looked at what was going on with the Treasury and what was helping support the metals markets. So that might mean we might need to see a recession. But really, what we're talking about is the catalyst for small cap performance is their borrowing costs, right? And so as long as we can get those shorter term rates down, because they tend to borrow in the short end, not the long end, unlike large caps, then we could see some promise to the IWM. But here's something I want to point out to you is, the IWM looks at all of these small caps, and a lot of them are underperformers in terms of they don't make any money. I think the number is like 50%. But some folks might not realize that there is another small cap index, which is the S&P small cap, which is the 600, and they filter out performance. In other words, they only look at stocks that actually are making money. And so you could look at those as a potential. Now, which is kind of interesting, and this is kind of contra to what I'm about to present to you is, but if we look at this by weighted alpha, right, and we think about what IWM represents versus like what this one represents, the top 5 performers in the small caps here is restaurants, energies, healthcare, rare earth, there's our MP, boom, boom, and military drones. So we go to the Russell and look at their constituents. So we do it by a weighted alpha. Their top 5 performers are quantum stocks, biotech, robotaxi sensors, fintech, and rockets. So really what you're doing here is, I think the IDM is a lot more speculative, and the S&P is more reliable in terms of performance. But again, remember what Tom Lee said last week was that he didn't really care about a company not making money today as long as that they have a lot of future potential. Certainly, I think quantum mechanics is going to be something that we're going to have to deal with in the near future, but a lot of these quantum stocks are not going to make money for another 5 or 10 years. And certainly biotech, you either make it or you don't make it depending on your drugs, and that takes a long time too. So for me, I think it's just as a preference here in terms of a trader. Do you want to buy a stock that, let's go to the chart here, is still below its 200-day? Again, look at this line of, this kind of that comfort line above and below. And, this stock has bounced off it. And again, the Russell's probably looks a little bit better. Let's go to the IWM here. Hang on, let me go this way. We'll go this way a little bit quicker. And here's what you're talking about. It got up to the 200-day, but it's back below this, what I would say, this line of comfort, right? So again, I would say wait until you see quantitative easing or some kind of reckoning that's going to help benefit these small stocks. I don't think there's a rush to get into either one of these.
All right, John. So let's jump from small caps to a company that is certainly not that. And that, of course, is McDonald's, good old Mickey D's. We talk about it from time to time. The reason why I sort of am bringing this up, John, is I was looking at the chart and this trend line sort of caught my attention.
Yeah.
And price has come right back to it. Now, if you extend this all the way to the summer of 2024, each time the price has fallen to this trend line, John, it's been a heck of a buying opportunity. And it's kind of especially interesting because the price of Mickey D's has fallen despite the fact that we've seen a bit of strength in the overall market. So it kind of leaves me wondering, John, should I stay away from this, or is this actually a decent entry? What do you think?
Is this the clash scenario, right? Should you stay or should you go, right?
Exactly.
All right, so here's my chart. Pull up my chart there, Tom. Okay. So that's what you were kind of saying. Down here we see the correlation or relative strength to the S&P that it has been underperforming during this most recent market move up. But what was kind of interesting is that on Wednesday I did a webinar on the lateral range, price range screener that we have, and this was a candidate that was in there, and then I showed that this gave a sell signal. And so I had a bias to this. When you asked me about this, I had a bias that it was going to go lower until you showed me this idea that it was bouncing off the 200-day, and I was like, oh, maybe I'm wrong on this idea that this stock could go lower because of it's holding the 200-day. But let's change. When I have a difficulty trying to figure out what I think the market is, I think it's always important to change your perspective. In other words, time frame. And so I have another template here. Now, this is the 40 weeks. So it's going to be a weekly chart. 40 weeks is kind of a similar to a 200-day moving average. Now, let me just turn off the Bollinger Bands here for a second, and let me get rid of this one moving average. And so I wanted to kind of show you a couple cool things. First of all, is when we look at McDonald's in general, okay, overall, there does seem to be this value that the 200-day is very important to it. Now, notice that in the green boxes here, how it holds the 200-day and then rallies off of it, right? Holds it and rallies off it, holds it and rallies off it. But on the other side, there also is this where we have these distribution patterns that are kind of rounded, and that when it tests the 200-day, you get these very vicious, short-lived sell-offs, i.e., our 3-candle drops. And there you go. 1, 2, 3. There's our 3-candle drop. 1, 2, 3, 3-candle drop. So here's my analysis, Thomas. We are right there. So I think the market is indecision here. But this stock for sure is one that really looks at this value. So if we come back next week and it's below the 200-day moving average, and I wouldn't be surprised that we get one of these kind of little sell-offs. But if we travel along the 200-day for a while and the greater market starts to improve, and then this stock starts to improve, in other words, that relative strength comes closer to the S&P, then I think you could buy this stock. But right now, I think you're right on the line of indecision.
All right. Great stuff there, John. Thank you very much. All right. So it's been a long week, John. We all work hard. I kind of like to slide into the weekend with a little bit of humor when the opportunity presents itself. And this just made me laugh so much, John. So United Health, it's obviously had a heck of a time, John, lately. And yeah. Jeffries, an analyst from Jeffries. Okay, so we all know Wall Street analysts. These guys make the big bucks, guys. $500,000 a year for this hard-hitting analysis. So an analyst from Jeffries, he cut the United Health price target by $1, John, from $400 to $399. And I'm just, John, I'm picturing an analyst sitting in his cubicle. Maybe he had a quiet week. He wants his boss to know that he did something.
He actually did something.
He tweaks his super secret pricing model a little bit, John, and the price drops magically by $1 to $399. Jeffries, thank you very much. I'm definitely going to use this analysis in my investing.
Awesome job there. Yeah, awesome job, Jeffries. I'll give you a thumb up on that one.
All right. So I think we got quite a few questions coming in, John. Are you ready to take some of those?
Yeah, I'm ready.
All right. So this is actually not a question, but a great point from Ming. Ming points out that quantum hasn't really shown itself to be reliable just yet. And I think that's a great point, John. It's way ahead of its time. As you pointed out in the small cap segment, these companies are not ready to make money yet. And even I think about 6 months ago, Jensen Huang, the CEO from NVIDIA, John, he pointed out, hey, quantum has great promise, great potential, but it is years away from actually doing something productive.
And to my point, it was two of the top performers in the the Russell are quantum stocks, right?
Exactly. All right. John, any thoughts on, the depletion of the strategic oil reserve and its potential impact on price? Do you follow that at all?
I do follow. I haven't looked at it in a while, to be honest with you. There is a lot of politics that are kind of played with it. Um, as far as an oil trader is concerned, right? Does it mean much when they say that they're going to sell oil or buy oil in terms of the larger picture, right? I mean, we consume like 100 million barrels globally every day, and so, they're like, oh well, we're going to release 1 million barrels over the next 6 weeks. Well, that is a minute amount of oil in the big picture. So in that sense, I don't think it really has a lot of meaning. But I do think that it is a kind of a sign of when we are adding to the strategic reserve, that does add a little bit of a base or a floor to the price of crude oil. So that's about all I really take out of it.
All right, this is a great question, and it's something I've tweeted a lot about Pepsi, John, symbol PEP, and it is trading at a 5-year low, and I'm kind of taken aback by that, because if you compare it to Coca-Cola has gone in the exact opposite direction. It's basically sitting near its highs. And the question, I guess, is why is Pepsi struggling while Coca-Cola isn't?
I don't know. It might be because it's strategic design, or in other words, Coca-Cola is just a beverage company, where Pepsi is not only a beverage company, but it's also a snack foods company. So maybe they have headwinds in terms of labor costs and input costs, to make Fritos and potato chips. So let's get rid of these two here. I mean, looking at this in terms of PepsiCo, Tom, it is, the Bollinger Bands are really, really flat here, really narrow. I do like the fact that we have just recently gotten a MACD crossover. What I would like to see now is the MACD signal lines get above the zero line. That would be a good sign for me. I'm just curious on this one. One of my favorite templates that we have on our bar chart templates is our TTM squeeze. Oh, super excellent. So I think there's potential here, Tom, is that we are in the squeeze. In other words, that volatility is something we just talked about on Wednesday's webinar. I would go and check that out, folks. Is the market is in a volatility squeeze, and that we're waiting for some kind of catalyst to push it out. Now, I would, if I had to make a bet here, that if we were going to get a breakout, it would be to the upside because of what you just said. It's at a historically low level. But the squeeze is on. There is a potential for this to make a big move as soon as we get what is called the firing. Again, something that we've talked about before. So keep that one in mind. That's one we'll have to watch, Thomas.
Good stuff there, John. All right, so we got a question, John. You might not know this stock because it just had an IPO, but it's Circle Internet Group. CRCL is the symbol.
And what's it again?
CRCL.
We won't have it up yet, right? I think it's just
we do have it up.
Oh, we do.
Yeah.
Okay.
So obviously, I mean, this is one of probably the best IPO launches I can remember, John, in quite a few years. So for those of you not familiar with this company, they're involved in cryptocurrency. They manage the stable coin USDC, which is a huge stable coin. There's been a lot of talk about stable coins lately, John, and the promise and potential and future usage cases of stable coins. So I think that is maybe leading to why Circle has had such a successful first week. John, do you have any thoughts on Circle and what it might be?
Yeah, it was an interesting story that came out. It was that Walmart and Costco and a lot of these large retailers want to build a stablecoin consortium. Is that what it is?
Yeah, consortium.
Yeah, that they have their own stable coins, which would mean they would circumvent Visa and MasterCard, right? Wouldn't have to pay for those fees. So look on the opposite side of here. Look what Visa did today. It was down 5% on that news story. Now, I think this is a knee-jerk reaction, and there are some regulatory issues that they have to get by, but it is a really good sign that, if you asked me a week ago who are the dominant players in the credit card world, and would they be dominant for the next 3 to 5 or 10 years? I think both of us would agree there would be Visa and MasterCard, and we'd say, yeah, nobody's ever going to compete with them, right? They have such a competitive advantage. But technology is a disruptor, and this would certainly be a disruptor, right? I mean, imagine if you could buy a cryptocurrency. And this is the thing I've always said about crypto is I don't understand Bitcoin, but I do understand blockchain technology. And I say, here's really the benefit of crypto is if you could buy a crypto and then go walk into Walmart and you wouldn't have to pay any credit card fees, and the retailer doesn't have to pay any credit card fees. You're eliminating that middleman in transactions or transaction fees. And that is a huge disruptor. So that's my thought on that one.
Yeah, there's a couple points, and then we'll go on to the next question. But John, we talked about the Credit Card Competition Act in our preparation call. I think it was on Monday. And what this is, guys, is it's being attached to the stablecoin legislation right now in Congress, John. But basically, what it could do is reduce the interchange fees that Visa and MasterCard sometimes charge on their premium cards, and it would allow retailers to just choose, the fees that are best for them. That could have an impact, a very negative impact on Visa and MasterCard. I don't know if it's going to pass. We'll have to wait and see, but that's one thing to keep in mind on the horizon. Now, as far as Circle goes, John, I would not be a buyer here. It's gone too fast, too furious. I don't usually like to buy shares immediately after an IPO because I feel like I'm being used for exit liquidity for those who got in at a much better price. What I would do is I like the company and I like the stock, but what I might do, John, here is wait for the next crypto bear market when prices really come down. You would expect Circle to sort of follow that as well. And then I might look to establish a position in Circle. So that's what I would do. You guys, of course, are free to do what you want, but that's kind of my approach here, John.
Yeah, I'm very skeptical about IPOs myself, unless you got the in on the first day.
Yeah,
I'm a big proponent of let's see where this stock is 6 months from now, and I don't worry about missing out on price appreciation because usually, like you're right, usually what you get is you get that first impulse, and then eventually you get some type of a pullback, and then eventually if the stock is worthy, it will continue to go higher. But yeah, it's doubled in, let's say, 2 days. I mean, I agree with you on that one.
John, do you think seasonality could have any effect on the price of McDonald's?
Well, it was something we kind of wanted to talk about, right, Thomas? That we wanted to look at the seasonality of the S&P, and again, a bigger picture. We could look at seasonality of McDonald's. Folks are traveling, a lot of interstate travel, right? I know when my wife and I are in the car, it's not that I'm a big McDonald's fan in terms of, Happy Meals and although I do like their French fries. But we stop at McDonald's because the bathrooms are always pretty clean, right? But I know that's weird. I'm sorry. But, look at the seasonality from June through July for the S&P is, boy, over the last, 15 years or something, there's not a lot of red in June or July. So in terms of seasonality for the S&P, I think that's a positive. Now let's look at McDonald's, and I wonder what its seasonality is.
It's sort of, for the most part, on July, it feels like it's just following what the S&P normally does.
Yeah, it's a little bearish going into June, but then July, August, it looks like it's a little bit better. It's about a mixed bag here.
Yeah,
but overall, it does have a positive performance through the summer.
Yeah, I mean, it's definitely positive, basically, across the board. But looking at these, I don't immediately glean any information from looking at the McDonald's seasonality. It feels like for the most part, it's following the S&P 500.
Yeah.
Now, if around Christmas time, if they announce some sort of super secret Happy Meal that had a special toy, John, maybe that would drive sales. I don't know.
Well, I mean, they always seem to incorporate Happy Meals with some kind of major motion picture release. I think right now it's Leo and Stitch or something. So, I mean, those things sometimes drive sales, but
John, we got
It's
a
about French fries and clean bathrooms, as far as I'm concerned.
Well, I'm with you, John. I agree on all that. And actually, if when I'm traveling internationally, sometimes I might be at the airport, John, and I'm hungry and I'm looking for something. My go-to is basically always McDonald's. I'll get the fries, I'll get the chicken nuggets, I'll get a Coke, and then I'll be nice and satisfied going into the plane.
There you go.
John, do you think so this is about 30-year Treasury bond yields. And I guess the question is, do you think market participants are engaging in some sort of activity that prevents the yields from going above 5%? And it's
that's what we just talked about. We talked about how the Treasury is, it seems to me, is putting a put on, right? I mean, it's the Tony Montana theory, right? You don't want to buy your own stuff, but that's exactly what they're doing, right? So they're putting this floor under the price of bonds, which is keeping the yields artificially low. I think they're afraid if they let market mechanics let the 30-year note normalize, right? And here we can see the yield here, but let's look at this over a weekly time period. Right, we're just getting back to what I was considered more of a normal rate, which would be something around 6%.
One of our longtime viewers, Wayne, points out, this is a great point. I had no idea about this. He says Pepsi might be struggling because Costco is switching to Coke in their food courts. So they're switching from Pepsi to Coke.
No Coke, Pepsi. No Pepsi, Coke.
All right.
But you're a Pepsi guy, aren't you?
I do prefer Pepsi. Oh, to be honest, though, I just go, at the supermarket, I buy whatever's the cheapest. John, I have no idea on this question. Is the Treasury able to finance its buybacks with increased tariff revenues?
Well, it's receipts, right? The Treasury takes in receipts. I guess that's where they're getting it from, right? I don't know.
Yeah.
I think it's just a lever that they, it's just a ledger input in some kind of electronic ledger. I do have a guy we could get. I know who knows how the Treasury works. We could get him as a guest if you want.
We got a question. I'm not sure I'm understanding it. It's about Tom Lee sees Bitcoin going higher. Can you explain the impact on any coin? I'm not sure what that means, but Bitcoin, yes. I think Bitcoin's going higher. Tom Lee thinks Bitcoin's going higher. Tom actually said it could potentially go as high as 250,000, 250,000.
Yeah.
I don't see that. And as you guys know, I'm a big crypto proponent. I think it's going to have a great second half of the year. Fingers crossed for that. But I don't see it going to 250,000. If it got to 150, I would be thrilled. If it got to 170, John, I would be looking to potentially start exiting.
Are we coming into? I mean, you're the crypto guy. Aren't we coming into a new cycle or season where we get this rotation out of Bitcoin into the altcoins? Is that coming up now?
Well, there's a hot debate about that, John, because I've said for the last year, in order to see these other coins really take off, I feel like the Fed has to sort of end its quantitative tightening and go to quantitative easing. They haven't done that, and I haven't seen any signs, John, that they're going to do that.
Right.
I'm not even seeing signs they're going to cut rates anytime soon. I think that's a big problem for altcoins. The one coin that seems to be bucking that trend, John, is Ethereum, which has performed very, very well of late. And actually, John, if you pull up, just to help our viewers, if you pull up ETH BTC chart, you can see how Ethereum is performing against Bitcoin. And that'll really put things into perspective.
What do you want? ETH
BTC.
Okay.
It was in a huge downtrend, John, over the last few years. But look what it has done. It's actually outperforming Bitcoin over the last month and a half or so. So I like to
But
look at
still, in relative terms of Bitcoin, it's very, very cheap, though, right?
it's been destroyed by Bitcoin over the last few years.
Yeah.
But I like to look at these charts, John. I like to see what coins are doing against Bitcoin, because if they're not outperforming Bitcoin, you're better off just owning Bitcoin.
Yeah, exactly.
It's a much safer investment. When you take on altcoins, you're taking on more risk, potentially for less return if they're not outperforming. So I guess the question, John, here, this person got back to me. They were saying, what would the impact be for Coinbase?
Coinbase.
Yeah. So I guess, I mean, I would think it would be a benefit. I mean, if Bitcoin is taken off and maybe altcoins are also participating in the rally, that's going to be a good thing for a crypto brokerage.
Yeah. I think there's other things we have to be worried about with Coinbase, but I don't think we have enough time to discuss that. Right? Maybe we'll do that for another segment for another time. But certainly Coinbase would benefit from any type of increase of crypto activity, especially Bitcoin, right?
Yeah. All right. I think we got to most of those questions, and I think we're coming up on the end of our time. So I think we'll wrap it up there, guys. Next week is Juneteenth on Thursday, so we are going to take the week off. I'm sure some of you have some fun long weekend plans. So we will see you back here in 2 weeks.
In 2 weeks' time, we'll be back. And until then, folks, best of health, manage your risk, and the good of all trading.